Hello, hello. Hey there, everyone. Happy Wednesday. Hope everybody's having a good week. Welcome to our August monthly workshop here inside the Badass Moneymakers. Apologies that this didn't happen last week. I was a little bit under the weather, but glad we're able to get this topic covered this month. So today we are going to do the workshop first. If folks have questions, woohoo, hey Mackenzie. If folks have questions, whether it's about the topic today or about just anything related to the money in your business, feel free to drop them in the comments and I will definitely answer them either as I go along or at the end, because we're kind of combining today's workshop with the monthly Q&A session. So, thanks. I am feeling better. I appreciate that. So let's go ahead and dive in because I do want to get this topic covered. And this is kind of a niche topic, admittedly. Let me take the "we'll be live soon" off. We're obviously live already. So it's kind of a niche topic, but it's one I wanted to come talk to everyone about because it has come up in conversations with some folks. And I know most of us, or I shouldn't say most of us, but a lot of us, especially if we're in the online business, are probably not using our car or any kind of vehicle in our business, but some of us are. And so I wanted to touch on this topic this month because there are some pretty specific rules around auto expenses and vehicle purchases and things like that within your business. And this is a topic that definitely can trip some people up. And so I want to make sure for those folks that this applies to that you understand the rules. So I'm going to go ahead and just dive in. And then, like I said, I'll answer questions at the end if anyone has specific questions. So, okay, I'm going to change the background too. I want a little bit more contrast there. That looks better. I like that. Okay. So there are two possible deductions that we're going to talk about, tax deductions that we're going to talk about today. The first is when you actually purchase a vehicle, and the second is when you operate the vehicle. Now, most people that I work with, it's the operating the vehicle that is the common tax deduction. Not a lot of us in this community are probably going to be in a position where we're purchasing a vehicle, through the business. A lot of us don't have businesses where we've got trucks or delivery vans or anything like that. But we're still going to talk about it in case that does apply to you. But mostly what we're going to talk about today is the operating the vehicle tax deduction. So, there we go. So the first thing to understand, and this is going to be the case with any business expense, is that auto and vehicle expenses can only be deducted when they are a legitimate business expense. So anytime we're talking about a legitimate business expense, we're talking about something that has to be both ordinary and necessary. Ordinary meaning it is a common expense in the type of business that you do. So for example, if I am an online course creator and I don't meet people in person, I don't go to physical spaces, I do everything online on my computer, it's going to be hard to justify that an auto expense is going to be an business expense in the ordinary course of doing business. It's just not applicable to the type of business you do. The other part of this, for it to be a legitimate business expense, is that it's necessary. Necessary is kind of a hard word here to understand. We can all sit here and argue, well, what's really necessary? Do I really need that filter for my Instagram photos? The IRS isn't going to get that nitpicky about it. When they say necessary, what they're really saying is this something you need to do your job? So again, if I'm an online course creator and I deliver all of my courses via the internet and I've got a computer at home and all of that, I don't need a vehicle to help me do my job in that case. So that's the first thing, is making sure that what we're looking to deduct is even a legitimate business expense in the first place. Now, when we're talking about operating the vehicle, we've got two deduction methods that we can choose from. The first is the standard mileage rate. So every year the IRS publishes a very specific rate, and they say you can take a tax deduction for business miles driven of X times however many miles. The other option is the actual expense method. That is where you're going to keep track of your gas and your insurance and your maintenance and any taxes you pay on the vehicle and all of the expenses of operating the vehicle. You're going to track those, and then whatever percentage of the miles you drive, you'll get to take that percentage of the expenses as a tax deduction, okay? So, hold on, I want to go back. Did I skip it? No, we're good. Okay. So a couple of considerations before we move forward on this. So the first thing is that employees are no longer allowed to deduct mileage for business purposes. This used to be the case that employees could deduct mileage as what it was basically called an employee expense. It was a specific type of tax deduction section on the return, it's not an option anymore. You have to be self-employed. So what this means is, so if you are a sole proprietor, if you are the owner of a single member LLC or a multi-member LLC or a partnership, you're fine, you're good. If you are an employee of your own S Corp, it's going to get a little tricky here. It doesn't mean that, doesn't mean that you can't do anything to get that tax deduction, but you've got to handle it a little bit differently. And bear with me 1 second here. No, we're good. Okay. So Mackenzie's got a question. Random question. If you operate your biz out of your vehicle, like a van nomad, do you get to count it as office space? That's a really interesting question. So I think it would depend, like a lot of things, on the facts and circumstances. So what I would say first and foremost is, do you live in the van? So if you live in the van and it's also where you have office space or where you work out of, then arguably, just considering options for the future, that's what Mackenzie says. So arguably, we could take a home office deduction for the portion of the van that is your home office, much like you would do if you had I was about to say stable, that's the wrong word, permanent, non-movable house, right? It's rare, and I'd want to definitely check the tax laws on that, but I think we could argue that case. If you have a van that you've just decked out and it's a cool space and you kind of made it into your office space, but you don't live in it, you don't really drive it necessarily or whatever, then yeah, we might be able to argue that that's office space if there are costs associated with that. It's not going to count as vehicle expense, it's going to count more as office space. And then the third would be if you drive the van and you work out of it, I would say in that case, it only becomes a deduction if it would make sense with the type of business that you do that you would need a vehicle to drive around, right? So like if you have a food truck business, then naturally you're going to be able to deduct the expenses for driving around, whether it's mileage or it's actual expenses, because you're a food truck. You literally, by nature of the business you do, need to be driving around. But again, if you're an online course creator and you've made your van your office and you're driving around, you don't need to drive around to be an online course creator. The driving around is for pleasure or for personal or whatever. So it's kind of an interesting one. But again, you need to go back to, let's go back to our slide a few slides ago. Nope. That it's got to be ordinary and necessary. So think about it in that context. Does this make sense for the type of business that you have? And is it something that is necessary to do the job of your business? That's what I would ultimately come down to. So back to our considerations. I mentioned if you're an S Corp owner and employee, things are going to be a little bit different. We'll talk about that in a little bit. The other thing that's really important to realize, and a lot of folks get tripped up on this, is even if you are self-employed, even if you own your own business, the miles driven from your home to your place of business are not tax deductible in any circumstance. They're what we call commuting miles. And they are not deductible for employees. They're not deductible for business owners. They're not deductible for freelancers. They just don't count. And the reasoning here is because anyone is expected to be able to drive from their house to their job and back. So if your office isn't in your home, if you've got a co-working space or an office space and you drive from your house to that office space and back, that is not deductible. Now, if you drive from the office space to a client site, that's deductible. If you drive from your house to your client site, that is deductible over and above your commuting miles. So you'd look at, well, what is my sort of standard commute? And then what do I add on to that? Okay. Another consideration is if you use your vehicle 100% for business, you can deduct 100% of your miles or your expenses, depending on which method you choose. But if you use it for business and personal, which most of us do, you can only deduct the business portion. And it's really important if you're using it for any amount of personal that you are tracking your miles. And we're going to talk about this in a couple of slides, but that you're tracking your miles because the IRS does require certain pieces of information to be recorded to substantiate the business miles. Now, let's dig into that standard mileage rate just a little bit here. I'm drinking my lunch, so bear with me. So the standard mileage rate I mentioned is published by the IRS every single year. It gets adjusted every year for inflation. And this is a deduction per mile. Now, you need to keep in mind that this only applies to passenger vehicles, so not a delivery truck, for example, that have a gross weight of less than 6,000 pounds. And by the way, some vehicles like bigger Range Rovers, I think the Land Cruiser might fit into this, are actually over 6,000 miles. So in that case, you've got to do the actual expense method. You can't do this standard mileage rate. But for most passenger vehicles, the standard mileage rate is applicable. So for 2021, for example, the standard mileage rate was 56 cents a mile. So if this were you and your business and you drove 5,000 miles for business in 2021, you would get a tax deduction of $2,800, or 5,000 miles times 56 cents per mile. Now, under this method, you cannot take any other deductions for the vehicle. You can't take you can't deduct insurance, you can't deduct gas, maintenance, none of that. That is all factored into that 56 cents a mile. You also can't take depreciation, which is when you deduct the cost of the vehicle over time. That 56 cents a mile is meant to encompass all of those expenses. Now, on the flip side, if you do the actual expense method, you can deduct all of that, but you've got to keep a record of every expense related to your vehicle. So if you don't track it, you can't deduct it. Now, and again, expenses could be something like insurance, gas, repairs and maintenance, vehicle registration, vehicle like excise tax, I'm trying to think what else, inspection stickers, all of those things would count for deductible expenses. If you use the vehicle 100% for business, you can deduct 100% of the expenses. But if you use it for personal and business, you have to proportion it. So you can only deduct the business portion. So let's look at an example. Let's say you drove in 2021 a total of 20,000 miles. And of those 20,000 miles, 5,000 were driven for business, 25%. Now, remember, you have to be able to substantiate that. So you're going to have those miles tracked. You're going to know exactly where you drove, on what day, and how long. Now, let's say your expenses in 2021 were $6,000 for the car, $3,000 for gas, $2,000 for insurance, and $1,000 for maintenance. So your 2021 tax deduction in this case would be $1,500, or 25% of those total expenses. Now, remember, in both examples, we drove 5,000 miles. But notice how in this example, standard mileage rate, 5,000 miles, we actually got a deduction of $2,800 because we used the 56 cents a mile rate. In the actual expense method, we only get a deduction of $1,500 because we used actual expenses. In this case, let's say our car was paid off, so we didn't have a car payment. Our expenses are actually pretty low for the vehicle. So it would actually make more sense for us to do the standard mileage rate. We would get a bigger deduction, and that's completely allowed as long as you drive a passenger vehicle under 6,000 pounds. So the question then is, what option do you choose? Well, it's pretty simple. Which one saves you more money? And the secondary to that is, if you want to do the actual expense method, can you keep up with the documentation required? Because remember, you've got to track your gas, you've got to track your insurance. Gas is kind of the hardest one. And you have to track it. Ignore what I was about to say. But you've got to track it, and you also have to track your miles. You've got to track your miles either way, but you have to track more with the actual expense method. So if you're willing to do that work, if you think the actual expense method might be better off for you, great, then you can take that, you can do all that tracking, and then at the end of the year, figure out which method is actually better and go with that one. If you don't want to do that administrative work, or you suspect that maybe the actual expense method probably isn't going to be better, then just go ahead and do that standard mileage rate. Now, in either case, there is required documentation. I've alluded to this a couple of times, but in either case, you have to track your total miles driven, which you can track by writing down your beginning of the year miles and then your miles at the end of the year. And then you also have to track your business miles driven. So what was the date? Where were you going to and from? What were the different locations? How many miles you drove for business purposes? And what the purpose of the trip was. Doesn't have to be a paragraph, but just a little something. Went to visit client, went to a conference, whatever it may be. You only need to do that for the business miles. You don't need to track your personal miles, because remember, you're going to track your total miles beginning to end, and then the business miles, so we can back that number out to get the personal miles. Now, where do you take this deduction? So it's going to depend on the type of entity you are and the type of tax return that you file. If you are a sole proprietor or a single member LLC, you're going to take this deduction on Form 1040, which is your individual, your personal tax return on the form within Form 1040 or within the tax return package called Schedule C. This is where you put your other business income and expenses. Okay, so it's going to go on that Schedule C. If you're a partnership, it's going to go on Form 1065. And if you're a corporation, it's going to go on Form 1120. An S Corp, it's going to go on Form 1120S. So it just depends on where, on what type of business you have and what form you use to report. Now, I mentioned earlier, there are some considerations for corporations or S Corps. So if you have a corporation or an S corporation and the employee, you, owns the vehicle, or any employee, it doesn't have to just be you, but any employee owns the vehicle, you have to use the standard mileage rate. You cannot use the actual expense method. This is why I cringe when I have S Corp clients and I see that they've run auto expense through the business. Not allowed unless the business owns the vehicle. But if the employee owns the vehicle, you've got to use that standard mileage rate method. And you have to reimburse the employee for business use of a personal vehicle. So basically what's going to happen is the employee is going to go to you and say, I just drove 100 miles last month for business purposes. And the business, the S Corp, is then going to reimburse the employee for $56, 100 miles times the 56 cent mileage rate. Okay. Now, if you have what's called an accountable plan, that reimbursement, that $56, is not income to the employee. If you don't have an accountable plan, then it is taxable income to the employee. And if you're wondering what an accountable plan is, I think we actually did a workshop on this a couple months ago. But it's basically a document that establishes what's called an accountable plan for your business that really outlines how certain expenses get deducted. I'm going to tell you before I dive, in fact, I'm not going to dive into all the specifics of this because it can get a little complicated. If you have an S Corp and you don't know about this, either ask your CPA if you have one. If I'm your CPA, let's definitely talk about it. We probably already have. Or if you don't have a CPA, this is probably a good time to get one. If you are an S Corp, probably not a good idea to be doing your own tax returns. So your CPA can help you. They can advise you on how to get this accountable plan figured out. But the goal here is to have an accountable plan so that the employee isn't being taxed on that reimbursement for what is a legitimate business expense. Now, what's important for things like this is you've got to timely submit the documentation to substantiate these expenses. So when it comes to something like mileage, I recommend doing it monthly or quarterly. And if you are an S Corp owner and therefore also an employee of your business, you're going to do the same process. So this isn't just for regular employees. This is for you as well. You're going to submit your miles to the business and the business is going to reimburse you for those miles at that standard mileage rate. If the corporation owns the vehicle, so if the business itself owns the vehicle, it's flipped. You've got to use the actual expense method only. But if the business owns the vehicle, they can't use the standard mileage rate. They've got to track the actual expenses. And that is the only situation in which it's okay to run actual vehicle expenses through the business, where it's okay to use the corporate card for gas, for insurance, et cetera, et cetera. Now, the trick here, if the corporation owns the vehicle, is that it's limited to business use. So the corporation, the business, cannot deduct the personal portion of the vehicle use unless they treat that portion, the personal portion, as employee compensation, which means let's take a really simple example. Let's say the business owns owns a vehicle, and there are $5,000 in expenses for that vehicle for the year. Now, let's say that 80% of that vehicle gets used for business and 20% gets used for personal, okay? So $4,000 of that $5,000 is a legitimate business deduction. $1,000 is not, because it's for personal. So in that case, the corporation can do one of two things. It can either only pay for $4,000 of the $5,000 expenses. That's kind of hard to do because it's not like you can go buy gas and say, I'm only going to pay for $40, not $50. It doesn't quite work that way, right? So more than likely what happens is the corporation pays for the full $5,000 in expenses, determines that 20% of that amount, $1,000, is personal use, and then puts that $1,000 as compensation, taxable compensation, on the employee's W-2 at the end of the year, so that the employee will then have to report that $1,000 that the company paid for on their behalf. They'll have to report that $1,000 as taxable income when they do their tax return, okay? This is why you'll see a lot of companies have very strict rules about personal use of corporate vehicles. Or on the flip side, if the company is providing a vehicle as like an employee perk, as a benefit, that is taxable income to the employee because it's part of your compensation package. Now, I mentioned I wasn't going to go too deep into accountable plans, but I am going to just give you some high-level guidelines on the accountable plans in case this applies to you. But I cannot stress this enough. If this is you, highly recommend working with a CPA to make sure this is all set up correctly. So accountable plans have to state, and it's just a document. I want to be clear, an accountable plan is just a document. But this document has to state the following. Number one, that your expenses must have a business connection, meaning employees can't seek reimbursement for expenses that aren't business related. Number two, that your employee has to timely submit expenses to the employer. Now, there are lots of IRS tax cases about what timely means. I recommend that for most of these expenses, especially mileage or vehicle expenses, you do them on a monthly or quarterly basis. Something like the home office deduction, which we're not going to talk about in this training, but we will another one later, you can do on an annual basis. But for mileage, let's do that monthly or quarterly. And in the event that the company gave the employee any reimbursement or any cash up front before they actually paid for the expense. So if you got an employee going on a trip, let's just say, and you say, hey, here's $500 to cover your expenses. The employee must return any excess reimbursement that they don't spend on legitimate business expenses within a reasonable amount of time. And typically the IRS defines that as 120 days. So I just want to reiterate that this accountable plan is only if you're a corporation or an S Corp. Actually, it's only if you're an S Corp. And it's solely so that these reimbursements don't become taxable income to the employees / you, the business owner. So a question I get a lot, hold on, lunch. A question I get a lot from folks who do use their vehicle a lot in their business is, should I have my business purchase the vehicle directly? And this is a little bit of a trick question because it's a complicated answer. That's not an answer across the board, same answer across the board for everyone. There are a few questions you want to think about if you're considering this. The first is the purpose of the vehicle business related? It sounds maybe pretty obvious, but you want to make sure it is, because if the vehicle is not going to be used at least 50% of the time for business, you can't. You cannot have the business purchase the vehicle unless you're doing it as employee compensation, employee benefit, and you're going to make a taxable income to the employee. But assuming that's not what you're doing, it's got to be at least 50% for business purpose for the corporation to even consider purchasing the vehicle. The second thing to consider is it going to be used primarily for business? Basically what I just talked about. Is that the purpose of this vehicle? Don't try to get fancy here and think, oh, I'm just going to purchase a new fancy car for my business and I'll just sneak it through and it'll be fine. If it doesn't make sense for your business, it's probably not going to work out well for you in the end. Okay. And then the last question to consider is, what type of vehicle is it? Because there are actually very different rules depending on whether it's a passenger vehicle under 6,000 pounds, a vehicle over 6,000 pounds, or there's a specific group of vehicles that can only be used for certain purposes, like school buses, for example, or food trucks that are very specific to that purpose, and they have specific rules. So some of the factors to consider when you're thinking about having your business buy the vehicle, first and foremost, your business has to be on the title. If the business is going to take the deductions for the vehicle, they've got to be on the title. That can complicate financing, because now you have to get financing in the name of the business, not just you personally. And that may make it harder. It may make it more expensive. So keep that in mind. A lot of those like 0% things you see at dealerships may not be able to get that if you're doing it through a business. The other thing to consider is that insurance can actually be more expensive for a business-owned vehicle. So again, you may end up paying more just to have the business purchase this vehicle, which may not actually get you any return in the end. Let's look at a few of the different ways that you could structure this if you need a new vehicle within, to use for business purposes. So the first is you, the employee, you, the owner, purchase the vehicle personally. If you're a sole proprietor or you're a member of an LLC or a partnership, you take the mileage or the actual expense deduction like we talked about before, and that's it. Simple and easy. Let's not complicate things. If you're a corporation or an S Corp, you have the business reimburse you, you submit and have the business reimburse you for your business portion of the vehicle that was used for business purposes. Just like we talked about, simple and easy, okay? If you have the business purchase the vehicle, you may be able to fully deduct the cost of the vehicle in the year that you purchased it. However, if you sell the vehicle, you'll have to recapture this deduction. So let's say, and I'm ignoring for a moment the specific rules around the type of vehicle, but let's just say that you have a vehicle that qualifies to be fully deducted in the year you buy it. Let's say this vehicle costs you $50,000. You buy the car. The business gets a $50,000 deduction. But let's say that 2 years from now, you go to sell the vehicle. When you sell the vehicle, you've already gotten your basis, which is like your stake, your basis in that vehicle is zero, because the way your basis works is it increases when you put something in and it decreases when you take it out. So when you bought the vehicle, your basis in the vehicle became $50,000, what you paid for it. When you got a tax deduction for that full $50,000, that wiped out that basis. So now when you sell that vehicle 2 years later, your basis in it is zero. So let's say you sell the vehicle for $30,000, your gain on that vehicle is $30,000. You're going to be taxed on $30,000 because your basis in that vehicle is now zero. So the reason I bring this up is because if you're considering buying a vehicle in your business and you're thinking, well, I'm going to take advantage of these special rules that allow me to fully deduct the cost of the vehicle in the first year, that makes sense. But keep in mind, that is not a permanent tax deduction. It is a timing difference. And if you don't keep the vehicle long enough, you're going to end up just paying that tax right back when you sell that vehicle. Now, if you can't fully deduct the vehicle, so if any of the special rules kick in and you're not allowed to fully deduct the vehicle, then the business will get a tax deduction every single year for the depreciation of the vehicle. So depreciation is when we take the cost of something and we spread out the deduction over a period of time. Now, in either case, the business can deduct every single year the cost of operating the vehicle, like we've already talked about, the gas, the insurance, the repairs. That's totally fine as long as they're business related. They cannot be personal related. Again, personal use can't be deductible unless you're treating it as compensation to the employee. Now we're going to go down a little bit of a rabbit hole here for a second, but I mentioned in this example that you may be able to fully deduct the cost of the vehicle in the year that you purchase it. The way that you're able to do this is through something that's called, there's two things, through two options that are called the Section 179 tax deduction and the second option, which is bonus depreciation. So the Section 179 deduction, I know it's got a fun name, that is literally the section of tax law that it comes from, says that you can deduct a set dollar amount every single year, or not every single year, but a set dollar amount in the year you buy a new asset if it's related to your business. We're going to talk about the rules in a second. Bonus depreciation says that you can deduct a percentage of the cost of new business assets in the year that you buy them. Either one of these, or maybe even both, can allow you to take a deduction on a vehicle if the business purchases it. Now, Section 179 has some specific rules to it. So first and foremost, there is a maximum annual deduction of $1,040,000. And by the way, Section 179 is not just for vehicles. It also works for other assets in your business. If you were buying furniture or fixtures or equipment, it could fall under Section 179. Now with Section 179, you actually have flexibility with the timing. So you can deduct a portion of the asset cost now, and then the rest over time. You can deduct it all up front as long as it fits under the rules. You've got some flexibility there. You can also use Section 179 for real estate upgrades or improvements. We're not talking about that today, but just thought I'd throw that in case that's applicable to your business. However, under Section 179, you cannot deduct more than your annual business income. So if you buy a piece of it, or let's say you buy a vehicle for $50,000 and your business income for the year is $20,000, you can't deduct that full $50,000. You can only deduct up to the $20,000. So for that reason, if you're thinking about buying something that might be deductible under Section 179, you want to make sure you do it in a year where you can actually take advantage of the full deduction. Now, bonus depreciation on the flip side, instead of being a dollar amount, is a percentage amount. So it used to be that bonus depreciation was 50% of the cost. So if you bought a computer for $5,000, you could deduct in the year you bought it 50% of that, $2,500, and then you would depreciate the remaining $2,500 over a period of time. Recently, bonus depreciation was changed to 100%. It's not probably going to last forever. So this is not something that exist in our tax laws permanently, but it is around right now, and it's something you can, in theory, take advantage of. And again, bonus depreciation is not limited to vehicles. It can be applied to other assets as well. There's no annual dollar limit on bonus depreciation. So you can take as much of it as you want, as long as you're not taking more than the percentage that's allowed. Currently 100%, but when it's 50%, that's a rule you have to pay attention to. Now, with bonus depreciation, you can deduct more than your annual business income, and whatever excess exists, if there is any, carries forward to a future year to offset future income. So bonus depreciation is something that can get carried over, so you don't have to worry as much about bonus depreciation and sort of timing it right, because you can carry it over. Bonus depreciation must apply to 100% of the asset's cost. So unlike Section 179, where you can take part of it now and then depreciate the rest, with bonus depreciation, you apply it, it's like an all or nothing thing. So you're either taking 100% of the cost or you're not. And you also have to apply it evenly to all of the assets in the same category. So for example, in the way the IRS categorizes assets is by their useful life. So as I've listed here, 5-year asset. So, and I forget all the different categories, what fits into what, but there are 3-year assets, 5-year assets, 7-year assets, and so on and so on. And so you'll have like computers and furniture and fixtures and equipment, and they all go into different categories. So if you apply bonus depreciation to one asset in your 5-year category, you've got to apply it to all the assets in your 5-year category for that year. So you got to kind of think about that too. So in order to take these deductions on your vehicle, first of all, it's got to be eligible property. And as I said with both, it doesn't just have to be a vehicle. It can be machinery, furniture, fixtures. There's a whole list of things. Neither one applies to land or leased property. So just keep that in mind. It's got to be something that you purchase, but a vehicle would count as long as you don't lease it. You also, I said this before, but it's important, I want to reiterate it, you also have to purchase it for business purposes, meaning it's got to be used at least 50% for business. And you have to put it into service to take the deduction. So you can't buy something this year to lower your tax deduction and not actually use it in the business for 2 years. You've got to use it in the business the year you buy it. And it's got to be new or new to you, meaning you can't call your brother and have him sell you a car to take a deduction and then you sell it back to him the next year and he takes a deduction. It doesn't work. It's got to be new to you, meaning it doesn't. There are rules on like what counts as related party, but meaning it's coming to you from a non-related or an unrelated third party. So it's new or it's new to you. It's not something that you previously owned. Now, there are limitations for vehicles. I said this was going to get a little specific and a little wonky, so stick with me. This is where if you've got a tax preparer, it's a really good idea to talk to them because the rules are complicated and they change. There are limitations for passenger vehicles for Section 179 and for bonus depreciation. For both, if you've got a passenger vehicle, which is light SUVs, pickups, and vans, so under 6,000 pounds, gross, what do they call it, gross weight, you can only deduct in a given year under either 179 or bonus depreciation $11,160 for your car or $11,560 for a truck or a van. Those numbers do change every year. So you may want to, these are 2021 amounts. So you may want to check them if you're looking at this in a future year, but you're going to be limited to that number. Now, if you buy a heavy vehicle, probably not applicable to most of us, but just in case it is, if you buy a heavy vehicle, which by the way includes, like I said, heavy Range Rovers, Land Cruisers, I don't know what some of the other big SUVs are, but some of those big SUVs, any vehicle with a gross vehicle weight above 6,000 pounds, you can take up to $25,000 under Section 179, and then the remainder as 100% under bonus depreciation. So if you buy a heavy vehicle above 6,000 pounds, you can actually fully deduct it in the year you buy it by taking a portion of it under 179 and then the rest of it under bonus depreciation. I personally hate this rule because this rule incentivizes you to go buy a Range Rover over a Civic. And I'd rather for the environment you buy a Civic. So I hate this rule, but this rule does exist. I'm going to tell you about it, but I hope you don't use it. So bottom line is that there is a lot to consider when you're purchasing a vehicle that will be used in your business. I've just touched on the rules, but They are very complicated, and you really want to make sure that when you're thinking about buying a vehicle in your business, you're making sure, number one, that it makes sense to even have the business buy it. And number two, that you're structuring it the right way. You may have caught a couple slides ago where I said leased property doesn't qualify for the Section 179 and bonus depreciation. And that's true. There are specific rules if you lease your vehicle. It's not as simple as just deducting the lease payment. There are very specific rules around that as well. So I highly, highly, highly recommend, if you're going to have the business buy the vehicle, that you talk to your tax preparer first. All right, my friends, that's it. I tried to make that one not super long because I know that's a lot of details and it's a very niche topic, but I want to stop it there. If folks have, I see we've got a few folks watching over here on YouTube. I've got some folks here on Facebook. So if you are watching live and you've got any questions, whether about this topic or any topics, please let me know. And I'll get them answered. I'm going to stay here for a few minutes because I know sometimes there's a lag. So drop your questions in the comments. Hold on. Let me pull up my YouTube over here to see if we've got questions here. Bear with me one second. Okay. Oh, and I see. All right. So somebody has asked, this is over here on YouTube. Someone has asked a question about the child tax credit. Yeah, I can definitely talk about the child tax credit. I'm just going to give it another second. Make sure I don't see any auto specific questions. So I'm going to kind of stop it here with the auto workshop and start it up with our regular monthly Q&A. So let me answer this question on the child tax credit. And Mackenzie's got a question as well. Yeah, Mackenzie, drop it in the comments and I'll get to it as soon as I finish my child tax credit spiel. So I did actually recently, let me pull this up. I recently did a Facebook Live on the child tax credit, which is really helpful. And I'll drop a link to it in the comments when I get off of this. But I do just want to touch on some of the highlights. So the child tax credit, for anyone who's not familiar, it's a credit that always exists that essentially gives you a tax credit for having kids, for the existence of children. Now, a credit is different than a deduction. So a deduction reduces your taxable income. A credit reduces your tax liability. So a credit is actually better than a deduction because it's basically a 1-for-1 off of your liability, whereas a deduction only reduces your income, which then gets subjected to a tax rate. Now, there are two types of credits. There are refundable and non-refundable tax credits. Refundable means that whether or not you owe tax, you will get the money. So if you have a $1,000 tax liability, but your credit is $4,000, you're going to get a check for $3,000. Non-refundable, in that same example, would mean that $1,000 tax liability, $4,000 credit, you don't get that $3,000 check, but you don't have to pay the $1,000. So the child tax credit has always existed, but as a result of COVID, the government did improve it and also added advanced child tax payments. So these advanced payments started in July of 2021, and they are putting money in people's bank accounts for every child that they have through the end of 2021. And it's an advance on your 2021 child tax credit. So it's not extra money. It's just advancing you money that you would have gotten on your tax return when you file that tax return in April of 2022 for your 2021 year. So if you've been filing tax returns, you should get that credit automatically. And I want to just pull up real fast. Let me pull up my amounts here. So bear with me one second. Okay, so the amounts are, oops, let's get rid of that. That's not right. Hold on. Bear with me one second. That is not helpful. Nope. Sorry, I'm just trying to pull up my numbers. Okay, here we go. So the amounts are $300 per month per each child under the age of 6, and $250 per month for each child's ages 6 through 17. Now, this is up to. These amounts can be phased out as your income increases. So the income thresholds are $75,000 if you file single and $150,000 if you file married filing joint. Once you hit that adjusted gross income level, then these credits start to phase out, okay? So you may notice that your credit isn't a full $300 or $250, and that's why. Now, they're going to base these credits on your most recently filed tax return. So they're going to look at your 2020 tax return. What was your income on that? They're going to base it off of that. If it turns out that you should have received more, that you're eligible for more, it'll get trued up when you file your 2021 tax return. So you'll fill out a form, they'll figure out the amount you were actually owed, you'll get the difference. If you are getting the payments and you don't think you should get the payments because your income has changed to a point where you don't qualify anymore, you can actually go on to the IRS's website and opt out. And I would highly recommend doing that if you know that you're not going to qualify for this credit, because you're going to have to pay these payments back if you keep them. So I highly recommend you do that. The other thing is, if you haven't filed a return, or for some reason you haven't received the credit. So let's say you have a new child, so the IRS doesn't know that the new child exists. You can also go onto the IRS system. You can update the number of children you have. You can update your information so that they'll start sending you these credits. So hopefully that answers your question. Let me know, to my friend here on YouTube who asked that, if you want me to expand on any of that. All right, so Mackenzie over here on Facebook has a question. If I'm paying, or actually over here on YouTube, sorry, Mackenzie's on YouTube. If I'm paying myself in a single member LLC, do I count it as owner drawing or payroll? It's a great question, Mackenzie, and the answer is owner draw. So when you have a single member LLC, as long as you have not made the S Corp election, which I know you haven't, in your specific case, I know you haven't, but for folks watching, as long as you have not made the S Corp election, then you would pay yourself on owner's draw, which means transferring the money from your business bank account to your personal bank account. You don't take out any taxes. You don't need to pay any payroll taxes. What you will want to do is make sure you set some money aside in a savings account to pay your quarterly tax bills, because for that very reason, that you're not having any money taken out for payroll taxes, you're going to likely owe some money for your quarterlies. And so you want to make sure you take that money out. So yep, you're welcome. Absolutely, Mackenzie. All right, I do not see any more questions. I'm going to give it just a few more seconds in case there are any lingering questions from folks. Otherwise, I will go ahead and wrap this up. As a reminder, this month, August 2021, is a little bit different because I am going to be out of the office the August 20th through September 6th. So we are not going to have our second Q&A session of the month, the 4th week of August. We're just not going to have it. We've gone ahead and canceled it. We are going to have, let me pull up my calendar here. We are, however, going to have next week. I'm pretty sure we are. Yes, we are. Next week, we are going to have our money meeting session, but it's not going to be on Thursday. It's going to be on Wednesday. So it's going to be Wednesday, August 18th at 2 p.m. Eastern. Now, that is the one thing every month that is not on StreamYard, on YouTube, on Facebook. That is the one thing that's on Zoom. So that is where you're going to join the Zoom call. It's not going to be recorded. The only thing that would be recorded is the beginning, where I do some tips and tricks for money meetings, and then I stop the recording. So come to that. It's a Zoom meeting. It's a chance for you to do your money meetings. We'll all put our mute buttons on. We'll all go do our money meetings, and you can ask questions while I'm sitting there and while we're doing them. So just want to make sure everybody realizes that it's on Zoom. It's not the same link as you would have used to find me today. The Zoom link is, we'll send it around, but it's also on the membership portal. And if you have access to the membership calendar, which we'll make sure we get sent around as well, it's on there as well. So, but we'll post in the Facebook group. We'll spread it around. So, all right, I don't see any other questions, so I am going to wrap it up there. I hope everybody has an awesome week, and I will see you all next Wednesday. Bye.